Hi, Greg Weldon here. I'm your host for Money, Markets, and New Age Investing. This is season 3, our final episode of the season, episode number 13. It also is our 41st episode that we have produced, which now there's an episode for every year I've been in this business, which is kind of interesting or sad. I'm not sure which. But at any rate, we have a lot of important stuff to talk about. I think you are entering a moment in time and space that is critical to how the medium to longer term future plays out. Meetings between Xi and Trump coming up. Hold the key. This is the most important point in history from this point forward. Now, before we get to all that, I need to do some housekeeping, which is to go through the just released CPI number, which the press called soft, softening, softer. And I see this word all over the place in the news stories. And I just didn't see it. It wasn't soft at all. There was nothing in here that was soft. All right. And of course, that goes on to play into the narrative that it creates the path to cut beyond next week's meeting, meaning multiple cuts in 2025. And right now is around a 60% chance of that implied by the futures prices, that you will get 2 more cuts by the end of the year. What's interesting is if you kind of look at further out and where you are, it doesn't really matter because ultimately it comes down to where do you expect to be by the end of next year, in the next 15 months. The bottom line is there's a 62% chance that you will have cut 5 times by then, and you will be at a 2.75 to 3% target range for the Fed funds. Now, that prices in a lot, especially when inflation is still anywhere from 2.5 to 3.5, depending on what measure you look at. And if you look at service prices, it's even higher. All right? I mean, so it's kind of interesting to me to see how this is all priced in terms of using the midpoint against the futures market, because there are various ways to do this now. It's become more of an art than a science per se, even though it should be a science, just by using the midpoint. I mean, the effective Fed funds rate right now is 4.11. The midpoint in the range is 4.12.5. That skews the odds because the effective rate's 4.11. So you would think you would move to the effective rate, but you move to the midpoint of the next cut, because that's where you would have an implied effective Fed funds rate once you got there. But true, the point here is that the inflation number is not good. I mean, they're talking about it being soft because the monthly rate was up only 0.3. Well, 0.3 is 3.6 annualized, and doing it with the most simple math or higher, right? You're talking about that's not soft, 3.6. And you say it's soft because, and how do you say it's soft when the year-over-year rate rose? Which means the 0.3 soft monthly rise was higher than the monthly rise was in September of a year ago. That's how the year-over-year rate increases. All right? So it's not only not soft, it's also not soft. And when you talk about 3 out of the last 4 months, you were in 0.3 or 0.4, which is 3.5 to 5% inflation. 3 out of the last 4 months based on the monthly number. The previous 6 months, you were 0.2 or lower, including negative, in 5 out of 6 months. So you had been soft. You're not soft anymore. All right. And the biggest thing to me was on the very first page of the BLS report, comes every month, first thing you look at, all right, is the 4 major indexes: the all items, the food, the energy, and the core rate, ex food and energy. I mean, you have had energy negative for over 2 years. Gasoline prices have been negative year over year for over 2 years outside of 4 months. Dating back to 2022, we're talking 3 years, over 3 years. The gasoline prices have been negative on a year-over-year basis, except for 4 months in that 3-year period. Basically, one out of 10 months. All right. This is the first time in 2 years that all 4 indexes were above the inflation target. I mean, you really have the first time they were above and rising was in 2021, 2022. All right. The lowest energy is 2.8, and that's despite the fact that gasoline was down 6% for the month. Think about that. And while the base effect had been waning, and we're getting to that point now where it's beginning to wane, unless gasoline rises, say 15 to 20 cents from here, you set up another negative base effect. But what happens when Trump hits Russian oil? Gasoline prices jump. You might wipe out that potential thing that holds inflation down when inflation is already accelerating and a kind of champing at the bit to get out of the gate, if you will. Both the core and the headline rate of 3%, that hasn't happened since January. I mean, it's only the second time this year both have been 3 or higher. That's not soft. Let's look at food. Food away from home is 3.7. Full service meals away from home, aka restaurants, 4.2. 4.2. That's more than double the Fed's target range. Food at employee venues, 3.8%. Mobile, food trucks, and vending machines, 6.3 year over year. Other food away from home, 5.3. This is not soft. This is hard. This is choking, especially when we talk about like food for employees, mobile food trucks, vending machines. You kind of are talking to kind of the go-to when you don't have much money in terms of where you might buy food because you think it's cheaper, but the inflation's even higher there. This hurts even the lower part of the income spectrum even more if you really extrapolate out the thought process. You look at energy, well, gasoline was down 6.3 for the month, and for the year over year was only down 0.5 because, again, it was down by more the same month last year. So it decreased less, which put the year over year rate almost up to a positive. And energy sector still as a whole was up 2.8 year over year. Why? Because electricity, 5.1, piped natural gas, 11.7. 11.7. Now, those are two of the factors in services, okay? Because we look at the CPI services, excluding energy services, and there's only two. It's electricity and natural gas. So the energy services are 5.1 and 11.7. The other 84 indexes, and I included all the indexes, so there's a little bit of repetition, but not that much. 84 indexes, 37 or 44% or above 4% year over year. 44% of service prices are more than double the Fed's target range in terms of the rate of inflation. 19 out of 84, or 23%, almost a quarter, are running up more than 5%. I mean, think about that. So it means basically you have a quarter running above 5 and then another quarter running above 4. Below 2, only 23 or 27%. All the rest are jammed in at 3%. So in total, you have 60% of service price inflation is inflating at more than 3% year over year. 44% at more than 4%, 23% at more than 5%. 1/4 of the services you pay for are running at more than 5% year over year. These are things people pay for all the time. If you have pets, it's even worse. Let's look at the city numbers because I always like to look at the major populations. It's like, okay, Montana inflation is this, but New York City inflation is this. I think we read New York City as a more important indicator of what inflation is for more people. I don't actually know the population of Montana, so that may or may not be right. No offense. But you know my point. You get my point. Okay, there's 22 cities that report, the BLS reports specific inflation rates for. They're all over the map. It really is interesting, seasonal, depending on which industries close to that city too. You can really get some real nuance of tells out of these numbers. 22 total cities, 11 reported every other month. So every month there's 11, and it rotates every 2 months. This month of the 11, 10 of them are above 2%. Only one is below 2%. That's only 9%. Well, there's 91%. 91% of cities running above target. All right? You're talking about 82% of cities running above 2.5%, and 64% of cities running above 3% inflation. And guess what? 27% above 3.5%. And guess where all 27%, which is 3 out of 11, all 3 of those are in California, where the governor has basically declared independence from the federal government. I mean, LA, San Diego, and Riverside, 3 highest in the nation, are all in California. When you talk about, it's really not stopping the bond market, all right? It's interesting because there's something else going on in the bond market. And I think it has a lot to do with trade. It has a lot to do with sanctions on Russia, with the trade war coming up, with rare earths. All of this stuff is so important. And at the same time, where I have said all year long, and you know this if you've been listening, that the Fed will ultimately acquiesce to higher rates of inflation to protect the economy, protect the consumer, protect the housing market, protect the labor market. We're there. We know they're doing it. I mean, they're already cutting rates even though inflation is 3% on CPI. I know inflation is PCE, but it doesn't matter to me. It really doesn't. Fact is, you're above target in every respect, notably so. And they're going to be cutting rates. And the projection in the money markets, in the futures market, in the swap market, is that they're going to bring the Fed funds rate down to a level at or below the rate of inflation. Why would they do that? Unless to protect the consumer. Why? Because guess what? Again, credit card debt higher than savings in pure numbers. Personal consumption expenditures outpacing disposable income every month now for months. All right, really dating back to the pandemic. All right, when the consumer crossed the debt black hole, or they're spending more than they're earning, and they've used their savings to do it. And now they run out of savings, so then they use their credit cards. And they run out of credit cards. The delinquency rate's the second highest in history. You have only the third ever in history, 12-month decline in revolving credit, aka credit cards. I mean, the consumer's choking. Inflation will be the dagger in the back of the consumer, even at the highest income levels. So, of course, the Fed is going to move to protect that. So the bond market's really telling us that. The bond market is also telling us that what we see, generally speaking, in terms of trade is deflationary as well. And it really is. I mean, when you start to look at the bond market, you have the 2-year note below 3.5, the 5-year note's now below 3.75, the 10-year note's below 4. The 30-year bond has dropped 55 basis points since Memorial Day. That's over 2 full rate cuts. It's gone from 5.15 to 4.55. Last at 4.60. About to break 4.5. Look at the ZROZ, Z-R-O-Z. You want to make some money in bonds, you can make some money in bonds. And that was kind of going to be the end. We'll put the end here because we're talking about the bond market. ZROZ is the zero coupon treasury bond. That's the longest maturity possible. It's breaking out on a long-term technical basis, multi-year trend reversal, the whole 9 yards. The MBB, double B, double boy, M, Mary, double boy. The MBS, mortgage-backed securities ETF, and aka mortgage bonds. You want to make some money? Buy the MBB. The MUB is the muni bond. I might shy away from that because there's a lot of municipalities like New York and Chicago and LA that could go bankrupt. But you want the leader is actually the emerging market bond market. EMB, Eric Mary Boy, is the EMB, is the leading upside bond ETF right now. You could also use the SHY, the SHY, which is the short-term treasury, versus the ZROZ, the long-term, zero coupon. The ZROZ is breaking out against the SHY, which suggests curve flattening, which is happening. So you want a maturity all of a sudden. But all of this revolves around the biggest deal that's going on right now, the biggest thing, the most important thing in the last decade outside of Iran having nukes is this rare earth battle with China. All right. I just did a special on this. If you want that special, I'll be happy to send it to you. It's going to carry a lot of the information I'm going to tell you about is in there. You want to see some cool charts, see the charts of all this. It definitely gives you a second level, understanding. I also did a special on silver. We've been bullish on silver this entire podcast. We recommended silver in our second podcast, and it is skyrocketed. You made a lot of money if you follow our recommendations, not only in silver, but also in the metals, mining, ETF, and the individual mining shares that we recommended, or not really recommended, talked about. We don't recommend specific stocks, but we'll talk about them, have been outperformers. All right. Recently, the spot silver market, in other words, you want to buy physical silver, costs $3 an ounce more than it did in the futures market to buy it for the end of December. That's an upside down market. That's telling you there's not enough physical metal. I explain all of this and the hashtag silver squeeze phenomenon, which has been around as long as I have. All right. When I first started in the markets, you had talk about this. It's only grown since. It is a real thing. We saw it flash its ugly head out of nowhere just recently. I give you some really cool charts from the swap markets, the lease rates, the open interest. All of this is really important. And how much silver is actually in the vaults that could be delivered against a futures contract. It's a squeezable market. Silver could easily go to $150. I was recently on a podcast and being interviewed, and the interviewer asked me about silver and could it go to 100? And I said, look, I remember when silver was, when gold actually was, introduced back into the market in 1971. I was a kid, but I remember, I was following this stuff. I was always into it, and that, gold. The price of gold was fixed at $35 an ounce. It immediately went to 110, like almost instantly. And it's like, yeah. And guess what? By the time I was, in the gold market, it was $300. I could easily see silver at $300. I have no problem with that. I really don't. $500. You want to make it a strategic metal, which China's already done, the U.S. is in the process of doing. You want to make it a tier one asset? It can replace gold, and gold's gotten so expensive. That's why the Indians are buying silver hand over foot, which is what precipitated this entire jam backwards into the London markets, where they don't have enough metal in the vaults to satisfy the demand for the physical metal. I give you a full report on that if you want to see it. It's really good. It's short, but it's good. I also have the CPI data in a report we just did, and this REE and REO along with the bond market special. All four of those reports are available. Just email me, Greg Weldon, GregWeldon, at weldononline.com. The REE and REO, rare earth elements and rare earth oxides, are key. There are 17 key elements, and the top 17 are key because they have broad-based militaristic applications, from communications devices to defense warning systems to weapons guidance systems. In fact, all of this started in 1947, of course, let's tie it to Roswell, when we all of a sudden come across new technologies, new kind of nanometals. We discover some, we're looking for also uranium. In California, we discover some of these rare earths. And all of a sudden, we got our own mine, all right, 1947. Through to 1986, when we controlled 99% of the rare earths on this planet. And we're completely self-sufficient. But that's going to continue with that in a second. The 17 elements, and excuse me if I say them wrong, there's some pretty kooky names. Cerium, which is with a C. Dysprosium, which I really like because it's a multi-dimensional metal. It can change its shape. And this will be key to sending a vehicle through a wormhole. All right, and I've done a lot of research on dysprosium going back into 2016 and 17. All right, erbium, europium, gadolinium, holmium, again, lanthanum, lutetium, neodymium, praseodymium, promethium. I've never said these words before. I'm reading this out loud for the first time. I certainly looked at it. Samarium with a U, scandium, terbium, thulium, urbidium, and yttrium, yttrium. Those are the 17 key REEs. All right. Okay, so the one mine that we do have in California, the Mountain Pass, which is on the border of California and Nevada, they produce carbonate, shonkinite, syenite. Is that on the list? It isn't. Alkali granite, leucotis genus, amphibolite, grandonorite ness. Man, these names are bad. Talonic ness, biotite ness, paletic ness. Not one of the 17 is on the list that comes from the mine in California. So we talk about, China produces 69% of them. They produce 97% of the key 17 rare earth elements. So this is much worse than even people realize. We don't even mine that stuff. All right? That's the military use. 1947, we opened Mountain Pass. All right? By 1986, we were the number one to hold 99% of these rare earths. And a lot of this, was for, nuclear energy and, propulsion systems of the time. This was stuff that was necessary, back in the 50s, 60s, and 70s, kind of pre-space age time. All right. But beginning in 1987, China begins to mine for this stuff. 1990, the communist government deems rare earths to be strategic metals to national security. They created the Chinese Society of Rare Earths, the CREIC, which is now a very powerful think tank, all right, more than a think tank, political, entity, all right. So they start in 1987. They make it a critical in 1990. They pass U.S. production in 1992. They name it also in 1992 as now a protected strategic metal, all right, where they have already started not exporting it. And by 1995, okay, in 8 years, they're producing twice as much as the U.S. And you're talking about, bastnaesite, and monazite in terms of the ores and key, again, none of which are in California, all right? This is a 40-year long game plan by China. This goes back to 1959. Why 1959? Chairman Xi, all right, in 1959 was 6 years old. His dad was among the top advisors to Mao Zedong, all right, and was killed in an assassination attempt on Mao. All right, 6 years old, Xi was whisked away by the Chinese Communist Party, literally living in caves in the jungles, being kept, and indoctrinated in the Maoist Manifest Destiny ideology. All right, he's groomed for this. They send him to the U.S. to get an Ivy League education. He's married. He presents well. He looks diplomatic. But he is a Maoist to the max with a Manifest Destiny. He has said specifically, his words, okay, not only do we want to be not dependent on anyone, but we want others to be reliant on China. Those are his words. He wants to create a better socialism than there is capitalism. Those are his words. I mean, and that, and I mean, gosh, I remember riding on the subway, going to a Ranger game from the World Trade Center when I worked on the trading floor, the gold and silver pits. I was in my 20s. This is back in the 80s, all right? And I just remember when the Berlin Wall came down, communism's dead, right? I remember having this conversation on the train as a 20-year-old in the 80s. The capitalism will die too eventually. It has to. Why? Because by then, the polarization of wealth had already gotten to like 1987, to Wall Street, to where greed is good. That was the time, the Reagan Revolution. We defeat capitalism by overspending. Starts the debt train rolling. The whole 9 yards. I've seen this entire movie. All right? And we're talking about the polarization of wealth is exactly what would bring us down. I remember saying that. Why? Because someday the have-nots will be in the majority. They will rise up and take down the powers that be. At least they will try. And then, of course, the best way, you want to read any kind of Russian, Chinese, communist, terrorist manifesto. I mean, the best way to destroy the U.S. is to let us destroy ourselves from within. Do we not see that happening right now? All of it? All of it? There were several times in the 2000s where China has suspended exports of rare earths and rare earth oxides. 2010, 2016. Both times, Congress got their act together, started putting together legislation that would allow us to mine more of this stuff because, of course, the environmentalists is going to have a problem with that. Every time, twice this has happened, Xi playing above the rim, the Michael Jordan of politics, the GOAT of politics, if you will, in the modern era. And I don't say that with any joy whatsoever. All right, true blue American. It pains me to say that. But you want the truth so you can prepare for what's coming next, you need the truth. And I'll give you the truth every single time. All right, every time it got close to legislation being passed in the U.S. Congress about rare earths, China turned the spigots back on and it went away as an issue. They have completely outplayed us. Way above the rim, the long game. You had clueless Joe Biden, they just walked all over the guy. At least Trump is a more formidable foe. All right, he's done some really good things. All right, but when it comes to Trump and trade, all right, and making America great again, it's kind of his core theme. He's the deal maker. He can make a deal with anyone. His ego is huge. We know this. His own worst enemy is his own mouth because he can't keep it shut for 5 minutes. We know he'd never be diplomatic, but we needed someone like him in this kind of dynamic. But in this instance, Xi knows this. Xi is a high-stakes poker player with a ton of patience, where Trump is an action junkie. He wants the deal done as soon as possible. Plus, he's on a timeline. Xi has no timeline. Putin and Xi can afford to play the long game. So can OPEC. Okay? It's a high-stakes poker game of I know that you know that I know that you know that I know. Bluffing, you can't call me anyway. Xi got Trump to bluff 150% tariffs, and then Xi went all in with REEs, REOs. He holds the world hostage. He holds the U.S. hostage. Is Trump going to fold? Or could there be an agreement? There could be, but I think this is the time and space that has been decades in the making for the Chinese. And the point of attack is right here. Why? I'm going to tell you why. Because there's bigger problems just in the REO space. In terms of output, China is 5-1, 210,000 metric tons a year. U.S. is 43. Australia's third at 18. Myanmar at 12. Thailand at 7. Vietnam at 4. India at 3. Russia at 3. Ukraine's not even on the list. Greenland's at 1,500. All right. So we're doing deals with like Greenland, and we want to deal with Australia, take some of theirs. We're still at 43 versus 210. All right. So let's say we add a third of Australia's. That's 6. We add Greenland, 7.5. We're at 50 versus 210. It's still 4-1 instead of 5-1. It's just not a game we're going to win in terms of just the output of the ore. And what's in the ground, 44 million tons in China. Vietnam is second at 22, Russia at 21, India at 7. The U.S., 2,300. Let me say that again. There are 2,300,000, I should say. 44 million versus 2.3 million. They're 20-1 in the underground ore. Brazil at 21 is a high one, too. I mean, Brazil's up there with Russia. It's Russia, Vietnam, and Brazil, then China. And the U.S. at the bottom of the list. The U.S. at the bottom of the list of in-ground material. All right? Guess what? It gets even worse. Why? It's not enough to take the ore out of the ground. Then you got to basically, create concentrate. You got to push it upstream. The supply chain. All right, we got to create the concentrate, then you got to do the separation, then you do refining into the metals and the alloys that you then use to manufacture products. There's 3 additional steps here in the supply chain where we have zero capacity, none. We have nothing that is working moderate. There's a very small separation plant. Yes, 1. All right. In terms of refining it into metal, 0. In terms of manufacturing the magnets and the guidance systems, nothing. Nothing. There's 0. 0 upstream at all. 0 downstream rather. It's all upstream. We begin at the upstream, but once it gets to the midstream, it's gone. And by the time it gets downstream, we got nothing. When you look at it from that perspective, and you look at the different metals, and you look at all this, we rely on them for 97% of our demand for these types of things in products, in oil, in all of it. And if we want to start putting our own stuff together, guess what? All right, here's the announcement from the Chinese, from the Security and Control Bureau on October 9th, to safeguard national security and interests in accordance with the export control law of the People's Republic of China, the regulations on export control of dual-use items, and the People's Republic of China, and other relevant laws and regulations with approval from the State Council of China, the following export measures are hereby adopted. Which means you got to use a dual license, and if you're an undesirable country, which is the U.S., you can't even apply for a dual license. And a dual license is extremely difficult to get. All right, and the whole idea had been, at the first point was U.S. wanted them to drop the dual licensing. Now they've made it law and are putting it in place as a national security measure, let alone that there's now an undesirable list what the U.S. is on. She just went all in, calling Trump's bluff. Trump still has chips left, but he's willing to go all in. Now, there's some people that think we should attack China first, right? Which is frankly kind of ludicrous, but, the point is they want chips and AI and quantum computing technology. Well, they can get that. It's all built out by the U.S. sitting in Taiwan. That's the real thing that's at stake here, is Taiwan, is chips, is all these other things that China wants in return for they buy soybeans from us. They allow us access to REOs, and they clamp down on fentanyl. Will we give them Taiwan for this? That's the big question. And Trump's going in there as if Taiwan's on the agenda for him to get China to say that it's independent. Xi has said he will never say that. We know that China wants a war, not with us, with Taiwan, with Vietnam, with the Philippines. They could win those wars. All right, in Vietnam, it's gas oil drilling rights offshore. In the Philippines, it's fishing waters. Again, man-made islands that Vietnam's put in place that extends their 2-mile international border to impinge on Vietnam and the Philippines. We've had incidents. But dating back to 2021 or 2022, I forget which year, one of those 2 years, the president of Philippines threatened to declare war on China, and China actually backed down for a short period of time. But these are incursions by naval vessels that are running down fishing boats and destroying them, and someone's going to get killed, and it's going to be a national incident. We've vowed to protect the Philippines. We've already pushed Vietnam to the Chinese. There's major trade deals now between Vietnam and China. China has brought them in closer. China's even brought Korea in a little closer. I mean, it's right across the straits. You want to talk about shipping? That's Malaysia and Korea. Those are the countries exposed there. And you know, Korea, I mean, the Chinese are doing flyovers in Malaysia right now, invading their airspace. All of this testing the defenses, poking and prodding and finding out. Why? They're ready for war. They're marching out their whole gosh damn army on their own national day. And this is why Trump wants to did the whole thing on July 4th. It was a response to what China did. Meantime, we're having civil war fighting within. You got governors in the U.S. declaring independence from the federal government. That's what Gavin Newsom said. I declare independence from the federal government. He says, I will not bow to a king. It's a declaration of war by definition. Basically declaring civil war here. All right. At the same time, we're taking on Venezuela and drug dealers, even in the Pacific to whatever extent. Colombia as well. New sanctions on Colombia now. You know, China's gotten in hot with Peru, where they own ports that the U.S. doesn't like anymore. Even to the degree that the Panama Canal is kind of in play. There's so much going on. Do we want to war with China right now? No, I don't think it happens. I think that we cave. I think it's one of those things, and I said this in my speech in Vancouver when I first laid this out, was really 2018, when the Chinese opened the Shanghai crude oil futures market and used the Dubai OPEC grade crude as the contract and priced it in renminbi and got Russia to benchmark their oil's crude against that contract. It was the beginning of the end for the dollar. Then came the BRICS unit. Then came sanctions, asset seizures, tariffs, double secret probation type stuff in trade that we've implemented and deployed as weapons. Financial markets are weaponized. It's a commodity and resource world war already and has been for at least 8 years. And we're going to take it up a notch right here. This is the time and point. And not only that, but Trump thought, hey, I'm going to hurt China's economy, and it's already hurting. And I reported repeatedly how much China's economy outside the property market was not hurting. All right, they have growth in final demand that's strong. They have loan growth that is strong. They have inflation is very low. I mean, are there some structural long-term problems? Of course there are. I mean, every economy in the world is a house of cards right now. I mean, that's also part of the problem. But at the same time, you thought you would crush their exports. You thought they would crush their trade, and that would backfire into a lower income and hurt the Chinese economy. It hasn't happened. In September, just reported last week, all right, Chinese exports were 300. What was the number? Where is my number here? Made a little note for this one. 328.7. I remember, I can't find my notes. 328.7 billion in September. That's the highest non-December export number ever in China. And there's only 2 Decembers that were higher. And December's a big, Christmas, the whole holiday thing. It's always the biggest month of the year. It's very seasonal. The September number was the 3rd highest in history, including all the Decembers. Was the highest ever for non-December. Not only that, but the year-to-year rate of change was 8.3. That's almost double August, 4.3. It produced a 90 billion surplus, all right? And 6 of the last 11 months in China has been a trade surplus of over $100 billion. Where's the hurt we're putting on China in trade? The cash register, cha-ching, 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 every single month. The U.S. consumer borrows $30 billion, and since our trade deficit is about 40% rare earths, I could safely say the U.S. consumer borrows about $30 billion a month, gives that money to the government in taxes, whether they buy it or income taxes or whatever it is, and then the U.S. government sends it to China for rare earths. Without China, we don't have this stuff, man. They hold the nuts, a.k.a. in poker terminology, the winning hand, the highest possible hand, with the cards on the board. All right? And now Trump hits up Russia with sanctions on their oil. I mean, holy mackerel. top two producers. Guess what? China, 2 million barrels a day from Russia. 800,000 barrels a day to the Chinese state oil company, to the Chinese communist government. You're going to, sanction that? You're going to tariff that? No wonder Russian jets just went into Lithuanian airspace. And then the EU says you'll be shot down. The EU and the UK have imposed tariffs. I mean, holy mackerel. In the meantime, you got Chicago, Los Angeles, Portland, New York, Minnesota, Virginia, all want to secede and declare war on the U.S. In the meantime, we're fighting with Venezuela, Colombia, Peru. I mean, do we agree? He just recently said in his speech after the 5-year plenum, Communist Party plenum, that brace for high winds and rough seas. What do you think he means by that? I know what he means by that. Do you think it's a coincidence that, this dates back to China opens the crude oil market 2018, 2020 Olympics. Biden doesn't go. Xi and Putin arranged for 100 trillion renminbi state bank financed 2 different projects, building a new crude oil pipeline from Siberia to China and engaging Kazakhstan for a new pipeline to reroute natural gas from EU to China. And guess what they did? They rerouted natural gas from the EU to China. How about taking over the Ukraine? What's in Ukraine? It's the breadbasket of Russia. They also have some REEs. But it's about food. And the ports. They took every port except for one, the most western one in the country of Ukraine. Every other port is now under Russian control. Why? They got the breadbasket, they got the food, they got the ways to ship it to China. Commodity war. Resource war, food and energy war, Russia, OPEC, China against the U.S. And then time is right before us now with a long game. The 40-year plan crystallizes in this moment in time and space that could be a denouement. What's going to happen in the next week is going to be huge. What's the missing link? China walks away from the table, somehow blows up this meeting, and the stock market crashes. It's the only thing that's holding up. And that raises unemployment. And by the summertime, the violence in the streets in the U.S. is doubled. The federal government's worried about Venezuela and violence in the streets. You think they're going to take on China over Taiwan? Do we not see what's coming? This is why bonds are in play. This is why precious metals are in play. Email me for my special report on the upside-down silver market. Email me for my special report on rare earths and the trade deal with China. Email me for my special report on the bond market and the CPI data. Greg Weldon, GREGWELD, at weldononline.com. Follow me on Twitter, at Weldon Live. See me on YouTube, Gregory_Weldon. Check out the podcast on X. I said Twitter already, on X, at money_podcast. And for a free trial to my daily research with specific recommendations, or for information on our money management business, where since 2018, we put this program in place specifically for this type of event that we're seeing coming, where we have outperformed just about everything out there except maybe physical gold and silver. Shoot me an email, Greg Weldon at Weldon Online. Thanks for listening, and we'll see you next time with episode 1 of season 4.